Hello everyone. In this video, we're going to be going through the topic of bill and hold, principal-agent relationships, and the non-refundable upfront fees. We just have one quick page of kind of definitions, getting familiar with the topics, and then we're going to go through one example for each one. Okay, these topics are not too bad, so let's just go ahead and jump in. Bill and hold, an arrangement where a company bills a customer for goods but retains physical possession of the goods because the customer is unable to accept delivery of the goods when the sale occurs. So basically what's happening here is that, a company is selling something to a customer, but the customer is they're not able to accept delivery, right? And the reasons for that could vary, but maybe their warehouse is full, or they just, for whatever reason, they can't accept delivery of the goods. They don't have space for the goods, or they don't want to accept them at that time, okay? This is a situation where we have to be worried about revenue recognition. When should we recognize the revenue? Because yes, a sale has occurred, but we have to make sure that nothing weird is going on, okay? And so basically, for a company to recognize revenue in a bill and hold arrangement, it must meet 4 criteria in addition to the change in control criterion. The change in control criterion is just saying that, the customer has control of the assets, that they can direct the control of the asset and do what they want with the asset, okay? So again, these are just 4 criteria. Do we need to memorize these? Probably not, but it's good to be aware of what they are. So there must be a legitimate reason for the bill and hold. Again, the customer can't accept delivery for some legitimate reason. The goods must be separately identified for the customer. The goods cannot be used by the seller, and then the goods must be ready for immediately transferred to the customer. Okay, so those are the 4 criteria you must meet to have a legitimate bill and hold. As long as you meet all 4 of these, you can recognize revenue for bill and hold. Okay, that's our main issue is, should we recognize revenue? When should we recognize revenue? And once we've met these 4 criteria, we recognize revenue for bill and hold. Okay, principal-agent relationship. This is an arrangement in which an agent helps a principal sell its products or services. Okay, so we have the principal, which is the company that provides a good or service, and the agent is the facilitator who arranges for the principal to provide the good or service. So basically, you have a principal. So in some examples, we have something like Travelocity, who's an agent who helps arrange hotel stays for Hilton, the principal. Kayak.com helps arrange car rentals for Enterprise, which is the principal. So basically, we have the principal who's selling a product or service, and we have the agent who's just helping the principal sell the product or service. From an accounting standpoint, we are worried about revenue recognition for the agent. Agents collect money on behalf of the principal. They collect the money on behalf of the principal, then they give it to the principal, right? That's how these principal-agent relationships work. And so agents should only record the commissions they make on the money collected for principal. It's not the whole amount of money collected for the principal. Okay, so that's our rule. We only want to record the commissions that the agents will earn, not the full amount that they have to actually remit to the principal. Okay, that's the principal's revenue, right? Then we have the last topic of non-refundable upfront fees. This is when a customer pays for a good or service in advance. Companies recognize revenue once the revenue is earned, not when the company receives the cash. Okay, so let's just go through a few quick examples. Bill and hold. On January 1st of 2017, XYZ company sells ABC company a piece of equipment for $70,000 on account. The company cost XYZ $45,000 to manufacture. On January 1st, 2017, ABC was unable to accept the delivery of the goods because it was remodeling its entire manufacturing warehouse, okay? So now it says, assuming that the transaction meets the criteria to be a legitimate bill and hold transaction, prepare the entries on January 1st, 2017 for XYZ, okay? XYZ is the seller. Okay, so basically in this case, it just comes out and tells us it's a legitimate bill and hold. Generally these problems are not too complicated. A lot of times they just come out and tell you it's a legitimate bill and hold. They're just, the professor, the TA, they're just testing you on whether or not you know what to do in that case. Okay, they also could say assume all 4 criteria are met, or they could list all these criteria. Okay, you should be able to identify the criteria. You don't necessarily need to memorize the criteria, but you should at least be able to be like, oh, okay, those are the criteria for a bill and hold. Okay. Again, or maybe identify if one was missing, right? Because if they gave you 3 and there's 4 or whatever, and you should be able to identify them, okay? So you should kind of somewhat memorize them, but you don't have to memorize them word for word, but you should more or less know what the conditions are, okay? In this problem, it makes it a little bit easy for us. So it says it's sold on account, so accounts receivable for 70 for the sales price, sales revenue for 70 for the sales price. That's very straightforward, very easy. Cost of goods sold, $45,000, so debit cost of goods sold, $45,000, credit inventory for $45,000. That would be the journal entries to make for the bill and hold. Again, it's a legitimate bill and hold, so we can go ahead and record revenue on January 1st of 2017. Okay? Principal-agent relationships. Okay? So Travel Agency Incorporated is an agent for Hotel Company Incorporated. Throughout 2017, Travel Agency collected $50 million on behalf of Hotel Company and remitted all these funds to hotel less a 2% commission. Determine the amount of revenue the travel agency incorporated should recognize in 2017. Again, as we said, our rule for this transaction is that the travel agency will recognize only the 2% commission. They're just going to recognize the commission that they receive as their own revenue. So it's 50 million times 2% commission is $1 million of revenue recognized. Again, the agent will not recognize 50 million of revenue because that is for the actual principal to recognize, not the agent themselves. Okay, so the agent just recognizes the 2% commission. Okay, just the commission that they get. That's the agent's revenue. All right, now our last problem: non-refundable upfront fees. Jim's Gym offers customers a deal where they pay a $100 fee to join the gym, and then every month after the first month is $20. Customers normally renew their gym membership for 23 months after the first month. Determine the amount of revenue Jim's Gym should recognize each month related to these memberships. Okay, so basically here, this is a non-refundable upfront fee because these customers have to pay $100 up front to join, but then every month after that, they have a discounted rate. Right, it's $100 for the first month, but then every month after that is $20, okay? These customers generally renew for basically 2 years, right? For 23 months, okay? So they're generally a part of the gym for 2 full years, okay? So what we do within revenue recognition here is that we want to recognize an even amount of revenue each month because this fee is basically seen as facilitating a lower rate for the other months, okay? So from an accounting standpoint, it just doesn't make that much sense to recognize $100 in the first month and then $20 each month after that because this $100 is basically helping to reduce this fee in the future. So that should be reflected when we're recording our revenue, okay? So what we do in these problems, and again, these problems they're always set up in the same way. What you do is you take the initial fee of $100, then you take the monthly fee, you multiply by the number of months, so it'd be $20 times 23 months, okay? Then you just divide by the total number of months or years or whatever you're doing. Okay, again, it's asking us for months, so we have to divide by months. Okay, so that would be $100 plus $460 divided by 24. They're going to recognize $23.33 each month for these memberships. Okay, again, the reason we're doing that is because this $100 is viewed as helping to reduce the fee for the months after the first month. Okay, and so when we're doing that, we want to record an even amount of revenue each period because then this $100 is recognized evenly over the 24 months, basically saying, oh, okay, like we should recognize this revenue each month a little bit to show that this $100 is helping to facilitate a lower rate in the future for the future months, okay? So that's the end of this video, and I hope that was helpful.